Hi, this is Jeffrey Cohen, coming to you live, end of the business day, January 26th. It's week 4 of 2022, and we're here to talk about the Chicago Quantum Net Score down run. We're going to spend a fair amount of time with the Federal Reserve Board's Federal Open Market Committee's earnings, like not earnings release, but their release, because they met for 2 days this week. And what they said they were going to do. Got a whole thing of notes. I'm going to talk about how the market responded to the market, because it was pretty dramatic. And although the market was up earlier in the day, the market ended up falling fairly dramatically during the call. And we're going to talk a bit about the Chicago Quantum Net Score run that we made. We made it last night after the market closed, and we picked stocks that would go down. What was interesting is that number 10 on the list dropped over 30% in the first 2 hours of trading. And so if you would have basically shorted or avoided these stocks, you would have done very well today. And I love the fact that the model's been working. What I don't love is that the market fell so much, because personally I have a bias that the market should go up all the time and everyone should make money. So, but that's just me. I'm also going to talk a little bit at the end about opening up a fund, either what I now know is called an advisor managed accounts or omnibus accounts. You might know them as hedge fund accounts or privately managed private wealth management accounts. And we're looking at doing an up and a down type of a managed account for potential clients. So we'll talk a little bit about that at the end. So let's jump right in. So the Federal Reserve made a discussion today, right? Made a release. You may have seen this picture where Chairman Powell talked to us about about it. And so what they effectively said was a few things. They're going to keep the federal... This is not big enough for you to see, so let's make it bigger. That's really big. So, interest paid on reserve balances will stay the same at 0.15%. The Fed funds rate is going to be the most important rate for the taper, for setting monetary policy, for fighting inflation. So it's all going to be about the federal funds rate. Right now, they're going to keep it where it's at, which is in a range between 0 and 0.25%. So you see this already and you think, okay, I mean, sure, they're going to raise it like crazy, but for now, no action. They are going to complete this month's quantitative easing, which is $60 billion. By the way, I look at the clock, it's January 26th. Next month, February, they're going to do $30 billion, and that's done. So, done by March. Afterwards, it's only for smooth functioning of the markets. So, the taper is going to be 2 months, January almost over, February $30 billion, and then nothing. But what they said in the meeting was that they are going to start to draw down on the principal. And so what I noticed here was they said they're going to roll over at auction all principal payments from the Federal Reserve's holding of Treasury securities and reinvest the principal. Not the interest, but the principal. But later on in the conference, they said they're not going to do that. They're going to start paying down the debt. And to quote Chair Powell, the balance sheet today is much bigger. The duration of the debt is much shorter. The economy is much stronger. I expect this to happen faster than ever before. We're going to significantly reduce the balance sheet. It may take us 2 or 3 meetings to give you the right answer on how we're going to reduce the balance sheet, but that's fine. We're going to raise rates, and we're going to reduce reinvestment of principal into new debt. That's pretty dramatic, I got to tell you. they're going to continue doing the reverse repurchase agreement operations. These are the ones that we've talked about on previous videos, where it takes, they're holding anywhere from $1 to $2 trillion a night, and they're going to keep that rate at 0.05%. And each counterparty can park $160 billion per day. That's crazy. All right. That's it. So they announced that. So what we did is we kept our eye on the market, and we said, you know, the market actually was up today. It was a good day today in the market. I can show you the stocks that we watch. I mean, so many stocks, right? And sectors, and it was all green. It was so beautiful. I mean, there were some bad stocks because of earnings. Boeing took a hit. Kimberly-Clark took a hit. There were a few. Rollins took a hit. But in general, market was up. Everything looked great. I want to show you a visual of what it looks like now at the close. It's a lot of red today. If we look at the full market, the market went red. Now, it's not all red. By the end of the day, it looks like maybe some of the NASDAQ, the bigger NASDAQ stocks did okay. But a lot of red. There wasn't this kind of red. Look at Alibaba down almost 5%. Verizon down 3.5%. By the way, Verizon is a leptokurtic, low variance stock. It never moves. It doesn't move. 3.5% in one day is like saying that the Shah of Iran is coming back to Iran. It's a big move, okay? Kimberly-Clark is another one of those. And maybe I'm going to find it, maybe I won't, but if I find Kimberly-Clark, you're going to see the same thing. It collapsed today. It was down 1 or 2%, maybe 3%, and that's not normal. Walmart's down 1%. Again, leptokurtic, low variance, that shouldn't fall. Kimberly-Clark down 3.43%. Now, I'm going to show you a chart on Kimberly-Clark because actually we called it based on the output of our model that Kimberly-Clark would fall. In fact, it was down at around 130 earlier in the day, and I'm going to talk about that right now. Right now, I'm just going to show you. So, go to your Yahoo Finance, type in Kimberly-Clark. By the way, I'm sorry earlier today, I had to shorten the wire for my microphone and it didn't work. So I'm really sorry that happened. So I'm re-recording it tonight, and in fact it's probably better because now you get all the good stuff here. So just Kimberly-Clark, and what we did, let's go back 2 years. In fact, I updated the chart, right? So we can actually use the upper line or the lower line, it doesn't matter. So if you look at Kimberly-Clark, it has been, since 2020, it's moving in a range. It came above the range here, came below the range here, but in general, it falls back to this range. Right around 142, 143. And so when this stock went up to 142, 143, we were about to buy put options. The problem is the whole market went a little crazy. We made a different investment, so we didn't make that bet. But that was a bet we wanted to make. So we watch it come. We watch it come above that 143 level. And our notion was to do 140 or 145 puts. And you notice here it crashed all the way down as low to 130, which is the bottom of the range. And so we knew that as it went up, it would come down. Now, if you follow the earnings, and we did, we read the earnings, we looked at the numbers. It's nothing unpredictable. It just said, oh, there's a supply crunch, and so costs are higher. So we made a ton of money now, but next year maybe not going to make as much. By the way, safe dividend. We raised the dividend, but next year's going to be tough. And of course, stock's up 10%. Stock never moves. The stock is like it's like a warm, comfortable blanket for widows and orphans with a nice dividend. And here it came down. So by just kind of mapping the trend and being patient, this is a move we had predicted, and we were communicating this stock to our clients as leptokurtic, low variance, and we did our homework and we communicated that to our client that this was a stock you might have wanted to bet on that it was going to go down. So I just wanted to show you. The other thing I want to show you is what happened. So, you got the earnings release, the Federal Open Market Committee release. And so I drew a line here. So the market had flattened coming in. I was actually on the phone at this time with Fidelity Investor Services. We were talking about custodial services to set up some accounts for y'all if you wanted to invest in our Chicago Quantum Net Score model. And so I'm like, yeah, let's get this call done before the earnings conference happens. And I was surprised. So it came out at 2:00 Eastern, and then boom, it went up. Maybe people took a quick look and they thought it's not so bad. And then it came down a little. And then it came up, and it was almost exactly where it was before. So this earnings release, this monetary policy statement didn't surprise anyone, didn't scare anyone, didn't scare me when I looked at it. I thought, all right, quarter point. This is actually what I thought. My mindset was, we're going to maintain federal funds rate at 0 to a quarter point. Cool. So they didn't raise. January's taper is $60 billion. February's taper is $30 billion. And then we're done. I'm like, okay. Not bad. Not bad. In fact, we probably got to do this for inflation. The only thing I would have hoped to seen in here is something about oil prices, how we're going to go after oil prices, but it's fine. No change on reverse repo. Overnight repurchase agreements, reverse repo agreements, no issue. Oh, and look at this. We're going to roll over to auction, and we're going to reinvest the principal. So, felt pretty safe. Felt very safe. Oh, and engage in dollar roll and coupon swaps as necessary. I'm like, this is terrific. No problem, right? But then the call comes, and Chair Powell, maybe he felt like he needed to be rough with us. So while I'm on the call, I'm tweeting. I'll pull up my Twitter account. I don't know if this is valuable for y'all when I do these tweets, but I feel like I got to show you stuff, right? Anyone else watching their day's gains evaporate during the FOMC? I'm like, okay, the Russell 2000 ETF is down 4.3%. That's the purple line. The candles is NASDAQ, which are the tech stocks, and the gray line is the S&P 500. And so it's kind of hard to see it from here, but basically the Russell was down 4.3%, and I'm praying that they'll just end the call. Maybe there'll be some technical issue, and they'll have to end the call, because that's 4.3%. Just to put it in perspective, the IWM fell 5.9% all year. All year. 253 trading days. And somehow Fed Chair Powell is able to make it fall in one day 70-80% of the fall for the whole year. It's so bad that my little stocks that I have, Corbis, fell like 5-6% during the call. Grow Generation was down 10% during the call. Even American Shared Medical Services, that traded like 6,000 shares all day, fell during the call. So I posted some things, but what was interesting was, I did them in order here. This was when it was only down 2.45%. And I'm like, oh man. And then it was down 2.9%, and I thought, no, it can't. And actually, the NASDAQ was falling faster than the Russell. And I'm thinking to myself, my clients, my family members that have retirement accounts, what are we doing to them? This is like, it's not on purpose either. And then it was down 3.5%, and the NASDAQ started, the Russell started collapsing. I'm just trying to figure out what to stop the bleeding, right? And then it finished down 4.3%, and it actually recovered a little tiny bit as the event ended. And I thought to myself, thank God it ended. But this was the worst earnings call, the worst FOMC conference call I'd ever been on. And so I posted this tweet. It got a like. Fool me once, shame on you. So in December, when the FOMC call happened, I think I was a little less capable and competent to analyze it. So I didn't sell my stocks. In fact, I bought more. I got trapped, right? Shame on you for doing that, right? Now, this next time, I did sell some stocks yesterday. Made profit. Was great. But I didn't sell everything, right? And so fool me twice, shame on me, because I should have known if you're going to go out there, you're going to talk down this market. And so the good news is this morning we published our CQNS down run, where we created a list of stocks to avoid or to short. And in fact, we put that list out a week ago, and if you would have shorted those stocks a week ago, you'd have made a killing, which is why we're looking at private managed accounts. And so we did it again today. I'm sorry, I made you have to go to our website because honestly, I want people to go to the website. And I published this picture. I published all the stocks this morning that you could have sold and you would have done great. And Cortexamy, CRTX was down 32% this morning. Lots of these were up earlier in the day. I was a little bit nervous. And the Fed starts talking and pretty much all these stocks cratered. I feel bad. So, but what I want to do, because I promised to do it for you, I'm going to wrap this up by saying I've never been on an FOMC call where they keep talking the market down. I don't understand. And so I think I do understand, and I got a book. But maybe I'm going to read you one or two more things that came out of the Fed call, and then I'm going to share with you the stocks. I'm going to keep them up on the screen so you see them. I owe it to you to give you a free pick. I'm hoping that you really like it. You make a lot of money on the shorts, and maybe you call me, you want to be a client, I'll get you your own short list, and we can customize it for you every week, every day. Doesn't matter. The list does change, not that frequently, but it does. So a few other things that the Fed talked about. They're going to have humility. I'm putting the mic closer to me here. They're going to have humility, they're going to be nimble, and they're going to be attentive to the risks. I feel like I'm talking to Vladimir Putin when I hear things like that. We're going to raise rates, and then we're going to address the balance sheet issue. But in fact, we're going to go after reinvestment and roll-off. We're going to shrink the balance sheet. He's talking about it. We're going to be led by incoming data, but we're going to make also decisions based on our forecasts. Both raising rates and reducing the balance sheet are required to move away from our highly accommodative stance. There's a consensus among the Federal Reserve Board members to raise rates. We have a historically tight labor market. It's great. The only thing that's not great, they talked about, was the unemployment rate's pretty high and labor participation rate's low. But plenty of quits, plenty of jobs out there. Anyone who wants to work, plenty of jobs. Wages are going up. Companies can't find quality talent. So he said, we're just going to go for it. He wants that high inflation not become entrenched. So I'm hearing all this. He talked about Eastern Europe. He talked about the risks of Ukraine. He talked about getting inflation down to 2%. Inflation's at like 8-9% right now. They're gonna basically crash it down to 2% as soon as possible and stay there. That's very aggressive. I gotta tell you, those were very aggressive words. And so these are the 20 stocks. I'm going to tell you just kind of what I know as I look through the list. So LWLG's been on the list a long time. It's been the number one dog. We dogged it at about 20. I think it's trading at about 7. So you would have made $13 a share if you would have shorted it when we first told you to short it. But some of these others are also down pretty significantly. Cortexamy was down quite a bit. Then you get a company like AeroCentury that restructured out of bankruptcy. There's a story to that stock, but I still stand behind having it on the list. And lots of these stocks. So just take a look. See if we're wrong. So what these stocks represent are stocks that move very aggressively, very volatile, but they don't go anywhere. They don't have the beta to follow the S&P 500. And so you're not going to get some of the benefits of a rising market, but you're going to get the cost of volatility. So that's this. I want to show you that. We talked about the Fed. What's interesting is the market didn't end that low. What's challenging is the fact that the market was having a very nice up day. It had risen quite nicely. And I can't get rid of that. I'm so sorry. And so it had risen earlier in the week. It had come down. It was making a recovery. And then this brought it back down. And so that's where we're at. You're going to see, we talked earlier this morning about treasury yields. Take a look at that 5-day chart. Take a look at the yields ended around 1.85. I wouldn't be surprised if you see 2.0 in the next couple of days for 10-year money. And because they're talking the rates up. And this isn't something that the Fed doesn't control. This is what the market controls. So I think you're going to see rates up. 2.0, if I had to make a prediction. So, last but not least, well, thank you for listening. I wish you good luck in the markets. I have no idea what it's going to do tomorrow. And just good luck, and God bless you. Hopefully it didn't hurt too bad that the market fell. And if you're interested in more information, just give us a shout. Markets have been weak, and they continue to weaken further. So that's where we're at right now. Oh, one book. Edwards and McGee. I'm going to read it again. Edition 5. Early editions are better than later editions. One thing they talk about is that, and in fact, the Dow theory, written like 120 years ago, they talk about when the government tightens, it makes stocks go down. So right now, I'm hunkering down. I'm going to wait it out, and hopefully I'll meet you at the other side when the market starts going up again. But yeah, the market return is 7.37% based on our model. Expected return next year. That number was always 19%, right? Which was capped, like a management cap on top of our model. And it wouldn't surprise me if that number goes to 5%, which is our floor. And that's it. Take care. Good luck in the markets. Bye-bye now.